But interestingly, the early investments made by people who wanted to make returns on their money were actually private investments. In the early part of the 20th century, one or two large private equity kind of deals were done. For example, in 1901, one of the wealthiest men in the country, J.P. Morgan, a famous banker, actually bought Carnegie Steel that had been built by Andrew Carnegie. And he paid roughly $480 million for that steel company, and a lot of it was leverage that he used. And that was, many people think, the first real leverage buyout in the United States. It turned out to be a successful investment, but not many other people had the wealth of J.P. Morgan. There weren't a lot of private equity funds in those days, essentially none. And as a result, there weren't a lot of other people following what Mr. J.P. Morgan had done. Some of his investors, like Henry Phipps, became very wealthy as well. The use of borrowed money to buy assets rather than paying in cash or stock was unusual and novel at the time, though it didn't set off an immediate trend. The industry that we now know as the private equity industry really didn't grow in the United States and elsewhere until after World War II. After World War II, a number of people who came back from the military service who had technology backgrounds began to say that they would like to build companies and use their technology skills, and they did so. They began to go to investors and say, we want to create new companies, we'd like to help develop new technologies. And they got money from very wealthy people, sometimes banks, sometimes insurance companies. But these people backed the first, what was then called adventure capital. It was such an unusual thing, they didn't call it venture capital, they called it adventure capital. A good example, one that became a very famous company, was Digital Equipment, or DEC, an early computer company, began to fuel more and more people saying, I would like to go into adventure capital. On the West Coast, engineers returning from World War II formed early venture capital firms and companies like Fairchild Semiconductor, which was backed by wealthy individuals like Mr. Fairchild. The phrase venture capital itself came about because these early investors saw their bets as real adventures. They didn't know what would succeed. The same thing happened at Stanford University. Silicon Valley emerged as a hub for technology, investments, and innovation. They began to follow the lead of Hewlett-Packard. It was fueled by some early venture money, further inspiring efforts to find high-growth companies and giving high rates of return to investors. When this industry started, the early venture capitalists, or adventure capitalists, said, we're a little different than people who invest money for you on stocks and bonds. What we'll do is we'll invest your money, but we'd like to be actively involved. And to be actively involved, we would like to get a piece of the profits. And ultimately, they charged a 20%, more or less, carried interest or piece of the profits, and that became fairly standard. In the 1960s and 70s, the industry really took off. These early firms also adopted a management fee structure